Let's turn now to how you can get defensive in the new year if you are worried about all that concentration within tech. Joining us with more, we got Brian Szytel. He is the Senior Managing Director and Partner at the Bahnsen Group. It's great to have you on. So talk to me about how you are thinking about maintaining a value-based investment strategy when you can just really rely on these tech names for so much of the gains that we've seen, particularly in the past 2 years, Brian.
Well, I think that's it. You know, the gains have come from those parts of the market, and the valuations speak to that. These names, a lot of them that you mentioned just previously, are trading 50, 60, 70 times earnings. And so for us, it's just too expensive. We've had move up in markets now 20% 2 years in a row. A lot of it has been driven by that particularly one tech sector. And so we look at other sectors and some more defensive names that provide more of a return of cash flow, return of income in the form of dividends to support total returns going forward.
So Brian, are you expecting a pullback? Or are you expecting more sideways action? I guess how should investors be prepared then for the next 12 months?
So if I were to choose between the two, I'd say more the latter. But let me describe it this way. Earnings expectations for 2025 are somewhere near 14%. So that's pretty optimistic, and that's already baked in. We're trading at 23 times earnings. So I think you could get a lot of good things happening. You could get tax reform come through the Trump administration. You could have the 2 rate cuts that everybody's now looking at for the year happen, and you could have earnings in double digits and still have market have some multiple contraction. And so the part of the market that I think will be most affected by that will be some of those overvalued sectors that you've mentioned. And so for us, it's not necessarily prediction of a bear market or a down market. It's just finding value and understanding where a total return is going to come from in the form of income more than just a multiple expansion or appreciation.
What should investors be looking at to kind of suss out those opportunities within value? Talk to us about how they should kind of be putting the microscope to some of the individual names they're investing in.
Well, I mean, if you're looking at it from a dividend perspective, a dividend growth perspective, which is how we look at the world, you're looking at businesses with high free cash flow that are paying out a consistent amount of that in the form of dividends, that have a very long track record of raising those dividends every quarter, and then have a fairly reasonable valuation along with a reasonable amount of payout ratio that is supportive of future growth of that dividend. So those are some of the metrics that we would look at. But it's not necessarily sector specific or market specific. We really do look at it business by business, and so company by company is the way I would approach it.
Brian, what would you say is the main risk for 2025 in the market?
I think it's expectations. I think good things can happen. I believe they will happen. So this isn't a negative comment. I think that it comes down to where valuations are already set and where those expectations are already set. When you're priced to perfection, markets tend to get disappointed. And so I would just say, keep that in mind. I don't believe chasing what has gone up the last 2 years is going to get you to where you need to be for 2025. This is the second move up in markets over 20%. Last time that happened was 1998. We sort of know what happened over the late 90s into the 2000s, into the aughts. So there's just a lot of things that rhyme with that period of time, with concentration risk in the market, with valuations. And I think this is a time to be a little bit more reasonable and sensible in the approach of how you're going to approach equities.
All right, Brian, thanks so much.